Good morning. I think it's morning for you, right? Yeah, I guess it's morning. Yeah.
Emphasis fine.
Yeah. So as you can see, I was searching like who is this song originally? And yeah, you're right. It's from this person, I think. Yeah, because then our singer took it. So interesting. Okay, so let's start with our session. It's curious because it's Saturday night for me, and for you it's Sunday morning. So I have like people outside like living the life. Like I don't know, it's like I'm in the morning, I'm in the night where I am. But anyway, welcome to Analyzing and Budgeting. This session will help you with some items for your MC planning. So hope this can help you. But also tell the things that I will tell you not as final truth, but take them as references so you can choose what you want to use for your planning. Of course, there are things that are generally true, but others you can choose what you want to use. So yeah, this is me. My name is Josely Rivera. I'm from Argentina in South America. So I come from Americas. I'm 28 years old. In case that you are questioning if you're too old to be in ISEC, you're not too old to be in ISEC. You can be in ISEC until I don't know when. And also I'm an accountant, but I don't work as an accountant, by the way. Like I have the knowledge of an accountant, but I don't like to do stuffs like, I don't know, taxation or audits. I understand, but not my preference. So in my career, I was team member and team leader of OGTA and also LCBP IGB in my home LC in Argentina. But then for real, I actually joined ISEC because I wanted to be in finance department. Literally, that was the only reason why, not the only reason, but the selfish reason why I joined the ISEC was because, okay, I have finance background. I want to join to this organization because maybe I can have the experience that I need to go on a GT. But then things changed, right? But finally, I got MCP finance position. Then I was MCP, as you are now. So I also can relate with you. And after that, I became team member, or during the same periods, I was team member, team leader, and later GFB chair of Global Finance Board. So also a nice opportunity to take after your MCP experience. If you're thinking, or if you come from finance background, it really helps you a lot in your professional lives. So for the objectives of today, we have three main objectives that are financial planning, introducing equity growth as the key metric. Why? Because equity now is one of the items that measures the success of ISEC 2025 implementation, more specifically for finance strategy. Then mitigate the current risk of planning in loss, because last year we had more than 60% of the entities planning in loss, and understand the limits for decision making. So based on the things that I will present you later, with more calm, you will read again the formulas and the concepts, and you will decide which of them makes sense for you or not. Okay, so starting with the framework, like where we are, or what is the core that guides our functions, we have the finance and legal standards. Finance and legal standards are designed specifically for ISEC and were reviewed only last year. So even if they are very old, like they came from 2012 around, like the very first standards that we had with those ugly designs, they were reviewed again for the second time last year, and we have our eight standards with a checklist with more of 120 items in the checklist that each entity has to implement. But since it is a lot to talk about, if we are talking about the standards, we will focus on analyzing and budgeting and what is the role that they play in our planning. So as I was mentioning you, equity is our new concept or the concept that indirectly was always there, but we were never like checking in detail, or we were not using it for our planning. But now it's introduced in our roadmap strategy as the measure, the main metric for the implementation of the finance strategy. So as you can see, equity is not only like an ISA concept, it's a concept that we use in general for any business. So if we want to read like only just the first concept, it says in business, it is what the net worth of the organization is. So in business terms, an equity account is what belongs to the owner of the company. So in the case of ISA, it is what belongs to ISF. So after paying all our debts, that is what belongs to ISF. So that it's say of that we have a net profit, or when we have a net earnings or to the owners, right? In ISF, we don't give to the owners, but we keep in ISF to do later more investments, right? So there are many things that you can do with the equity, and one of them, for example, in the last part, it says that you can check financial ratios like return on equity. Also, you can find the equity in the balance sheet. So equity is moving through the balance sheet. But let's see equity in an equation so you can understand better like where it is, where it stands, like in what part you can find it. We have this general accounting equation in case that you haven't checked the MCP Pro Financer Academy. This is what you will find also in the academy, where we have assets, things that we have that belongs to us, are equal to liabilities, that are the things such as like debts, things that we owe to other stakeholders, plus the equity. Equity is composed by initial equity plus revenues minus cost. So in other words, we can have like directly assets equal to liabilities plus initial equity plus revenues minus cost. And then I mentioned to you that equity you can find in balance sheet. Balance sheet, it's like a picture that you take in a certain period or in a moment of time. So let's say that we are on the 1st of July, just beginning our MC terms, and we have, okay, this is our assets, these are all our liabilities, and then this is the net worth of my entity, which I'm starting with for my term. Then 3 months passed, and you have a different picture. You take another picture and you say, okay, now these are the assets, the liabilities, and the net worth that my entity has. But in the middle, something happened. In the middle, what happened is the income statement or profit and loss statement. That one is measuring the performance of your entity, meaning that you are generating revenues and you are generating cost, and then you have net profit. That net profit or loss is added to the equity. So in other words, what we can find is that net profit in the income statement or profit and loss statement, and equity in the balance sheet, and equity is directly affected by the net profit. So again, we see the equation. We can say that if the first equation is like that, then equity can also be equal to asset minus liabilities. But we also said that equity is equal to initial equity plus revenues minus cost, that it's the net earning or the net profit. So how can I make sure that I'm tracking that the equity is growing? Or how can I make sure that I'm planning an equity that will grow? Okay, it's very simple, because we have the full equation, and we check, okay, in order to make equity growth, I have to increase assets, decrease liabilities, increase revenues, or decrease costs. They don't have to happen all at the same time with the same intensity, but there's combinations. So here is when it comes your part of analyzing, like how much I can increase my assets, how much I can decrease my my liabilities, how I will do it. I will do it through increasing revenues. I will do it by decreasing costs. And it's all about the decisions that you make in order to have the net profit that will push the equity growth. And this net profit can do two things: can increase assets or can decrease liabilities. So that is when it comes your decision. So the main three call to actions for that is that you have to consider equity growth as the final metric. Why? Because as I was telling you, is the metric of ISF 2025, and it's our way to make sure that we are contributing to our final goal. And also because it's the best metric that can make an impact in the other things that you want to improve. So for example, let's say that you want to create reserves, then you have to increase assets. Let's say that you want to pay liabilities, then you have the part of reduction of liabilities. Let's say that you want to do better cost management, so then you have to decrease the cost, or make the decision of which costs are the crucial ones in order to have more revenues. The second thing is that you should consider the net profit to evaluate the sufficiency of it and to support your entity needs. So for example, if I'm planning to have a net profit of 100 in my, I have to make sure that that 100 will support my goal of creating reserve, or will support my goal of paying my debts. And the last one is that every program should plan in profit every month, or annually in profit if monthly is not possible, because we all know that also we have, based on timelines, so some peaks of revenues, or some periods when we are just doing sales, for example. So now we will move to analyzing data for planning. Now that we understood the final one, let's talk about what are the things that you might analyze for planning. So as MCP and also as MC member, people usually mention MOCR, like months of cash reserve. Let's check how long we can survive with the current money that we have. It's very common, right? But then if we're focusing a lot on sales, we are doing projections and forecasts to check how long will it take for us to receive the money from our stakeholders. With that, what is the conversation that is happening? Cash flow, inflows versus revenues, because it's not the same earning that collecting. If we manage portfolio, we have exchanges, we have ELD programs, we have long-lasting connection, and with that, what it comes, the program's profitability, and we keep checking, oh, is our program profitable or not? We have then debt ratios in case that we have debts. We have also this year people of our focuses, so then we also want to analyze the people costs related. We have to check the previous profit and loss statement. We have to check the previous balance sheet to make a better decision on our own budget. And also it comes like, okay, how was the budget achievements of last terms? Now we have this introduction of equity trends, and all this can come in LC and MC data, right? And even more things, because these are not the only ones that we manage. And this is the moment when we realize, like, oh my God, maybe I don't know anything, or maybe it's too much for me to learn or how we'll do this. But stay cool. Why? Because you have departments. So your departments are the ones that should all actually know and do all these analysis for you. Not for you, but for the entity and for the purpose of the MC planning. So let's check now what are the departments supposed to prepare. And after that, we will have like some discussions about how is the perception of those things in your entity. So for now, you can take note or you can just listen, because anyway, you have this presentation as your notes. For later, you can check it again. Here are some disclaimers that I will not read all, but I will explain you like a few words. What is it? The department, it's not the same as program, so pay attention when I say program. That the departments depends on your structure. The programs don't depend on your structure, because the programs responds to the ISF portfolio. The responsibles also for the profitability of the programs are the program heads, not MCVP Finance, not you. I mean, you indirectly, yes, because you guide the entity. But the first ones are these persons. And the strategy, including the financial dimension, should come from the program heads and not from finance. Finance, what does finance is like check, like, okay, it looks good. In the trends, it looks like this, or I would suggest to do this, this, and this. But is the program head the one that should like learn and implement this kind of knowledge? And finance does the assessment of the feasibility of the strategy, the feasibility of anything that we are planning from the program side, and how it coexists with the operational costs that we need to run the entity. So let's start with portfolio. So in portfolio, we have again EWA, ELD, and long-lasting connection. And you can find about the portfolio programs in the global compendium. For portfolio, what we have is this amazing concept that it's gross profit. Have gross profit for absolute numbers like total revenue minus total cost. And we have gross profit margins that it will check or it will measure the efficiency of the program. With efficiency, we mean like how efficient is versus the cost that we need in order to have the revenues that we have. Don't worry about like what it's inside the boxes, but because you will read later. But the third thing is cash flow versus profit and loss. Why? Because it's not the same having the revenue that having the inflow. Maybe you did a sale to a partner and you said, okay, you can pay me in 30 days, but I already deliver you the service. I already give you the space in my conference, for example. So here is your invoice. So the time that it takes for the stakeholder to pay you is what will impact in the cash flow. And so I recommend you to pay attention on this, that we are doing it correctly, both cash flow and profit and loss, and to check the efficiency on the collection of the revenues generated. And the last one, and very, very important, that in majority of the cases entities doesn't do because it's too much work or I don't know how to do it, is pricing analysis. Choose a method to do, again, the pricing analysis. It's part of pre-attraction in the SOPs, so you will see it as part of the SOPs. And if you cannot conduct a market analysis, for example, or a competitors analysis, then at least do cost analysis to evaluate the current cost and the efficiency of these costs. Of course, this should be done by the program heads. An example of how you can do this analysis, for example, we have exchange profit and loss. We know that in AP we don't manage, for example, exchanges of course the plan and the execution will look different from other regions that specialize in them. But then when we check MC cost and revenues for EWA, the story is different, right? Because we have like more peaks or more trends for revenues coming from EWA. So it's not necessary for you to have like charts, but at least to have the numbers that will guide you to take the decisions. And then for BD, if you are an entity that manages BD, apart from gross profit margin, plan versus achievement, cash flow versus profit and loss, we have another things that we should analyze, that it's receivables days collection. How long does it take for BD partner to pay from the day the payment is due to collect? And this is really, really helpful when you are doing projections on cash flow, projections on when you will have money to spend or when you will have money to create your reserves. Then BD funnel, like which is the state, which are the states of the money, like if it is money, sign it. If it is money that we already earn it, if it is money that we will collect in the future. And of course, pricing analysis that I recommend you to do market research. And the last one, that is revenue distribution of BD portfolio. So BD usually has what? The same portfolio of what we have in the ISEC portfolio, but it sells in different ways. Then we have MXP and OD. We don't assess gross profits because they don't give us revenues, right? But there are a lot of costs that we should analyze that are people cost related. For example, conference fees, or for example, planning and development. So what I recommend you is to check the investment structure, to do an investment structure analysis, list all the costs that are related to people, and also make the impact assessment. What if I have them and what if I don't have them? Like, what is the thing that is affecting directly if I don't have them? And there you will find like other KPIs that you can track in order to assess the return of investment. It can be, for example, retention rate. It can be NPS. It can be many different things that you want to assess in your entity through these people cost. You can do people cost distribution, like from the total people cost that we have, how is the distribution of each of them, and cash flow of people cost execution, like when it happens and who pays that. So for this, I have this example. This is all AP data. So this is your region and how it looks for people cost related. So the blue bars you will see that are overhead costs HR, that are for MC are related to salaries, and for LCs are related to compensations like food, transport, things that we give to the members, not as a reward, but as something that it's included in the experience, let's say. And the second one that you can see that happens at LC level and also at MC level with a lot of like power is overhead costs related to planning, learning, and development. So in your entity, you should assess like, okay, what goes inside planning, learning, and development, and how can I track that it's giving me the correct return? The third one that comes here is coaching visits, for example. So what does it implicate to make coaching visits in my entity? And are these costs like the way that they are distributed following a timeline? Is it following the timeline of my entity or not? So now we will go to breakout rooms. And I have two questions, breakout rooms or 2 or 3, if 3 better. How does the suggestions looks like for your entity? And are we talking about these metrics and analysis in our entities? What are the kind of reflections or insights that you have until now? So I'm not sure if I do myself or the CC does for me.
Yeah, CC can support.
Yeah. Okay. Put 5 minutes better because I think I'm out of time. Join people, join, discuss. Still have one person or two that are okay. That's it. Let's see. Yeah. Still have one not joining. I think you can pause the recording. Okay, so now that we are here again, after your conversations, I have the final part that is, okay, what should be then doing finance, or what are the metrics that finance will be analyzing for before planning and after planning. And there are the overhead cost distribution and cash flow. With the overhead costs, we have HR, we have legalities, and we have office, for example, in case that you have. And then what other thing is the part of risk management, the impact assessment. And in this specific case is the impact of not having legalities in place, for example. Total budget plan versus achievement of the last years and also this year during your planning. And financial ratios like debt ratio, MOCR, MOFR, net profit margins, and the external factors that could be affecting the entity, for example, inflation rates. Each country has their things, so you will see what is the thing that you should be paying attention. Because in my personal experience, coming from a country that suffers hyperinflation, for example, for me it was non-negotiable to do my budget taking in consideration that. We will not do questions here, we will do questions at the end. So the final remarks that I have for you is how to assess our financial planning. Like after we did this pre-planning, during planning, and we are checking like all these things, the general things that you will need to check is the gross profit margin for the programs, that the target is 70% or more. If you have less, then you need to check that the net profit margin is achieved, that is 20%. But 70% is the target. Why? Because it's the benchmark that we take from a business that delivers services. And then we have 30 days maximum for receivables collection plan. Again, why? Because that will give you a better image on when you will receive the money, and also take in consideration the BD funnel that this 30 days is only for collection, doesn't include the period of doing prospection, doing the sales, signing, delivering, etc. And also because it will avoid the risk of non-collecting the receivables from partners. Then 20% of net profit margin, that is the target, 20%. This is overall budget, like total revenues and total costs. More if you have higher obligations. So it's not that you only have to have the 20%, but it needs to be enough to cover your obligations. For example, AI fee or AI debts or things that you or things outside your entity and that you need to pay. Or if you want to build extra reserves, for example, if you have a goal of, I don't know, 24 months of cash reserves to happen during my term, then I will need to check what is the net profit margin needed in order to do that. Equity growth, as we already discussed it, any growth counts. Even if it is 1%, you can have the opportunity to leave your entity in better state than you are receiving it. And then cash flow bigger than zero every month. Of course, we have exemptions. Of course, the months that we receive, for example, global affiliation fees, are the months that we have more outflows. So maybe those months are months that you are allowed to have like negative cash flow, but in overall it should be positive. You shouldn't end or you shouldn't have a plan that overall it's giving you a negative. Why? Because then it means that you are spending more money that what you are planning to receive. And the last one, and my favorite one, even if it is too obvious, it's do your planning in profit, because that will help to push the equity growth. Do it monthly, and also do it the calculation for the accumulation of the 12 months of your term. If it is not possible to do every month positive, at least the total result should be positive. As I was saying, all this at the same time. It comes in like a puzzle, but it's possible if you are checking the correct parts, and if each of the departments are doing their part, analyzing and planning correctly. If you want to find more about these standards, go to the Profit Academy for MCPs. And if you want to know even more, you have the MCPP Profit Academy, that literally is the same link, but instead of MCP, MCPP. And my last remarks are: use this presentation as notes while you're checking your plan, like net profit loss, check. Gross profit margin target achieved, yes. And also do your own research. As I said, like there are many other indicators that you can use and that can fit better your reality. And again, plan to have positive result, planning profit for a long-lasting entity, because that will help you to push the equity. So now, I don't know how much time do we have, but now we have questions in case that you have questions.
We have 3 minutes.
Yay, use your 3 minutes in case that you have questions, people. Or maybe you have so many questions that better to do later.
I have a question about more towards, I guess, liabilities. Again, I'm way out of my idea, but how do you look for the actually no, don't worry about it. I think question is how do you justify stipend, because right now the stipend is there for Australia, and the things like living costs or the cost of living is going to be higher. How do we actually allow, or how should we downscale these things for LCPs to also understand that, hey, these are things that is needed? How do I communicate that equity right now is important? or is there any GCPs?
Yeah. So the best way is first to have the full image of the entity, like balance sheet and the profit and loss statement, telling them, okay, these are all our assets or our liabilities. This is also the projection that we have that will happen. So every month we will spend in this, and this. That is the necessary to run the entity. Like, for example, for legalities reasons, we cannot pay less than this to the MCPPs, for example, or for legalities reasons, we need to pay this to the accountant or to the lawyer. That also happened to me in my year as MCP. Like suddenly my legality costs weren't into the double, and I had to explain this to the LCPs. But when they understood that it was legal thing that we needed to pay them and we don't have option not to pay, then it was agreed that, okay, we will increase the budget then and we will pay them, unless also that you have a different distributional model than where you pay one part of the MC budget and the LC pays another part. But that can be a longer discussion in case that they, let's say, don't agree to pay, or they still don't understand why they should pay. But always doing the breakdown of the cost that you are about to spend. That will give them more clarity, and it will be more transparent than only giving them like total, like, hey, this is the total now.
Thank you.
Okay. Anyway, if you have like more questions, if you feel that okay, maybe I need an extra touch point, you can contact a regional office, or you can also contact me to discuss like your ideas. Some people usually have like, I have this crazy idea of changing completely my financial model, and I want to know how it will affect my budget or my financial planning. Then you can ask me for a touch point or a call, and I will be more than happy to be in touch with you. Yeah.
Thank you, Yoseli. So proud of you. So proud of you. So proud of you. Okay, thank you. Thank you for supporting AP, and good night.